On September 15, 2008, one of the oldest and largest investment banks in America, Lehman Brothers, filed for bankruptcy. Within hours, a localized panic morphed into a global shockwave. Credit markets froze entirely. Over the coming months, more than 8 million jobs would disappear in the United States alone. Millions of families would lose their homes to foreclosure, and the global financial system edged dangerously close to a complete standstill. Trillions of dollars in wealth evaporated overnight, causing immense human suffering. Yet, in the aftermath of this massive systemic failure, barely any of the individuals responsible faced criminal prosecution. To grasp why accountability was so elusive, we have to look past the complex math and examine the seemingly ordinary foundation of the collapse, a dangerous psychological assumption shared by almost everyone. For generations, owning a home was the defining symbol of American success. It was the standard, reliable method for a family to build long-term wealth. By the early 2000s, that historic optimism began to warp. Housing prices kept rising, year after year, without fail. Buyers, sellers, and lenders slowly adopted a deeply flawed conviction: the absolute certainty that real estate values could never go down. That collective blind spot was the fatal flaw. Because everyone believed the asset was permanently safe, the entire A Florida truck driver named John. He earns about $45,000 a year, doesn't have much in savings, and his credit history is patchy. Despite his financial reality, a mortgage broker offers him a $300,000 home loan. The pitch is incredibly persuasive. The initial payments will stay low, and because housing prices always rise, John is assured he can simply refinance if things get tight. The originating bank happily approves this precarious subprime mortgage. They aren't worried about John defaulting because they have no intention of keeping the loan. They plan to package it and immediately sell it to Wall Street. By severing the connection between making the loan and holding the actual risk, lenders lost all incentive to verify if a borrower could repay the money. The priority shifted entirely to volume. Wall Street drops John's risky mortgage into a giant bundle of perfectly safe loans. This chaotic mixture is compressed into a new investment product, a CDO. The individual risk is completely hidden. Finally, ratings agencies blindly award these CDOs the highest safety rating, AAA. That simple AAA stamp acted as a form of modern financial alchemy. It instantly transformed a box of localized, highly volatile debt into a premium asset that appeared as secure as a government bond. Because of that premium safety rating, institutional investors worldwide eagerly bought in. Pension funds bought them, massive insurance companies bought them, and foreign governments purchased these CDOs. The commissions were enormous, and bonuses were steadily growing. With so much cash flowing through the system, practically no one paused to ask what was actually buried inside these lucrative investments. Through this deliberate chain of custody, John's precarious subprime mortgage in Florida was quietly and successfully hardwired directly into the foundation of the global economy. Eventually, the mathematical reality caught up. John's low introductory rate expired, causing his monthly payments to jump dramatically. At exactly the same time, the broader housing market finally stopped rising and began to fall. Homeowners across the country suddenly found themselves unable to afford their adjusted rates. Unable to sell or refinance their way out, millions of families began defaulting on their loans and facing foreclosure. As the individual mortgages failed, the true contents of those highly rated CDOs were exposed. They lost their value almost instantly, triggering a massive upward shockwave that quickly wiped out heavily leveraged hedge funds and major investment banks. Trust between financial institutions vanished, causing global credit to disappear overnight. Businesses were forced to shut down their operations, and everyday citizens panicked as they realized their basic savings might be at risk. Wall Street had designed this complex financial engineering to shield itself from isolated losses. Instead, by distributing that hidden risk everywhere, they ensured that the collapse of the American housing market dragged the rest of the world down with it. To prevent a total collapse of the financial system, governments were forced to step in. They deployed massive emergency bailouts, injecting trillions of taxpayer dollars to stabilize the remaining institutions. Investigations were launched, and corporations paid billions of dollars in fines. Yet the public was left profoundly frustrated. The specific executives and managers who built this toxic chain faced virtually no criminal consequences for their actions. In the years that followed, regulators forced banks to hold more capital, and general oversight improved. But while the structural plumbing of the market was patched, the underlying human flaws driving it remained perfectly intact. The crash of 2008 serves as a definitive warning about the destructive power of collective greed and the lethal certainty of believing that the old rules no longer apply.